It's an old cliche, I know, but there are only two certainties in life, and that is death and taxes. And invariably, there are four taxes that the likes of you and I commonly and ordinarily pay, and they are essentially VAT, which is value added tax, or whatever the equivalent may be, depending upon where you are resident in the world. And essentially it's a sales on tax and goods and services. It's what I describe as quite a discriminative or regressive tax, because it's payable by kids, the elderly, the working population. Doesn't matter where you are on the income or wealth scale, everybody pays it. Now, secondly is income tax, and this is predominantly if you are employed or even self-employed, and quite often it is deducted at source if you are employed, particularly, meaning you simply don't see it being paid to the tax office wherever you are. Your employer takes care of that through a PAYE, pay-as-you-earn system or equivalent. And income tax can also include dividend tax and some sort of form of social security tax, like national insurance here in my home country, the UK. And then thirdly, we got capital gains tax, which is paid on an accretion and disposal of wealth, commonly shares, securities, tangible property, residential or commercial property, and crypto certainly being the most common. And finally, you have corporation tax. Now, strictly speaking, you and I don't pay this personally. It's the companies we have control of as directors or shareholders that actually pay this. But nonetheless, it is another form of taxation. We all know we ultimately have to pay taxes, but can we pay less legally? And the answer is, of course, yes. There are always ways to mitigate or reduce your overall tax burden. And I'm going to give you 4 simple tips that you can apply instantly, pay less tax in the future, of course, legitimately. Number 1, and perhaps one of the most overlooked areas quite commonly, is to use tax shelters where available. And the 2 most common are pension contributions into a pension fund and savings wrappers like an ISA, which is an individual savings account. Pensions are designed specifically with retirement in mind, and historically pension contributions have always been considered the most tax efficient way to save, but you can only obtain the benefits when you reach a certain retirement age. That's the snag, to be honest. Nonetheless, a very effective way of shielding from the tax man when making your contributions into the pension fund. And in many countries now, when you're extracting your money out of the fund when you hit a certain retirement age, that is also becoming more and more tax effective, or shall we say there's an element of it which is quite tax effective. Now, if you watch the end of this video, I share a link with a video that I've done titled 3 methods to get your pension money tax efficiently when you do hit retirement age. So on this particular tip, to give you a quick numerical example as to how it works, and here in the UK, if I were employed earning, let's say 75,000 Great British pounds per year, I would end up paying 40% marginal rate of income tax. So I'm going to keep this very, very simple for you purists out there. I know you're going to say, well, there's a personal allowance, there's a tiered system, basic rate, etc. Yes, I know that. But the fact of the matter is, just for illustrative purposes, I want to keep this simple. So I'm going to pay 40% on my £75,000 per annum. And let's say my tax bill then is quite simply 75,000, 40% of 75,000, which is £30,000. Let's say I decide out of my 75,000 to make a pension contribution of £10,000 out of that £75,000 salary. So I then receive 65,000 gross salary for the year. Okay, that is now. And then 10,000 is put into a pension fund straight out my salary, and it goes gross, and it's transferred to my pension pot for my benefit later on in life. And it's tax-free. That contribution is tax-free. And again, for you purists out there, I know there are also annual allowances, lifetime allowances. There are limits as to how much you can put in tax-free. I get that, but again, I'm keeping it simple just for illustrative purposes. So my income tax bill is, now that I made that contribution, is £26,000 as opposed to £30,000 previously. So I've just saved £4,000 in tax by making that pension contribution. So there you can see the power of pension contributions. Another great tax wrapper is an individual savings account, or what's called an ISA. Now, this is certainly a UK thing, but again, there are equivalents of ISAs across the world, whether in the US, Canada, India, wherever you may be. And these accounts offer a number of tax advantages that are comparable to those offered by pensions. Anything you invest in the ISA, your savings, your investments, are free from tax. So when you're putting your money in, if it grows in this tax wrapper, and when you eventually take your money out by disposing or selling your investments. So an ISA saves you both income tax and capital gains tax. So there's two elements of taxation that you're saving here. And if you're in a conundrum as to whether to put your money into a pension or an ISA, then again, I've done a useful video on this, which you can access at the end of this video. So watch the end. I'm going to give you the link to the video, which you can access, which is basically called pensions versus ISA, which is the most tax efficient. Number two is to utilize your marriage allowance. Now, this is of course very restricted to UK taxpayers who are of course, well, married, and it's still quite an underutilized, often unknown tax benefit. So put simply, it allows one of a married couple or civil partnership to pass on 10% of your annual UK personal allowance to the partner. So don't forget, in the UK, you get a UK personal allowance, which pops up on the screen. This is for this tax year. This is the amount that you get, which you can earn completely tax-free every year. So if you pass on your 10% to your spouse or partner, certainly if in situations you're not utilizing it, so for example, you may have one partner's not working at all or on a very low income, then you can pass that on. And it results in a £250 tax rebate per full tax year. Now, here's the real silver lining here. You can backdate these claims up to 5 years. So most people will not have claimed this where they've been eligible or possible. And you may think, oh, am I going to do all that for £250? But you can backdate it for 5 years. So if you're eligible and the numbers work for you, you could be receiving a total of around about £1,200 in tax refunds just sitting there on the table. So again, I have done a more detailed video on this, which you can access in the link in the description box below this time. Number three is something called bed and spousing. Now, let me assure you, this isn't something kinky or anything like that. And again, it's very focused to UK taxpayers, or if you're in a country where you get what's called a capital gains tax allowance every year, where you can make a capital gain and not pay tax. Here in the UK, the capital gains tax allowance, certainly up until recently, was 12,300. It is changing in the next tax year. I'll come on to that in a moment. But the concept is quite straightforward, and it does rely on the cooperation of your spouse or civil partner, of course. As I mentioned, the rate of capital gains tax allowance is dropping from 12,300 to £6,000 per person, and then even lower thereafter. But let's just look at the principle. Let's say you had some investments like shares, and about 1,000 of them worth about £20,000, for example. And let's say you sell 500 of them for £10,000, so 50% of them for £10,000. You've made no gain or loss. Okay, I'm going to keep this as simple as possible. And your spouse literally buys them back almost instantly, or very soon after, for the same price or a similar price. So let's say in this example, £10,000. So what happens here is, so long as there is trust and unity between you and your partner, and you now collectively hold the same amount of shares or investments, but you've doubled your capital gains tax allowance because you're now utilizing both of yours. This can apply to selling property, crypto, or any other kind of capital asset. A very, very useful little tax tip. And number four, last but not least, is something called business asset disposal relief. Now, this is perhaps the least simple method or tax tip of the four that I've presented in this video, and only really applies if you have a limited company business, for example, with cash or liquid funds in it. So in other words, your business must actually be solvent. You see, when your business makes profits, it pays corporate tax, or the company pays corporation tax on those profits. So in the UK, it's 19%, soon to go up to 25% for small to medium SMEs. And once that is paid, any profits after tax remains, you would normally pay yourself, the shareholder or shareholders, by way of a dividend. And dividend tax rates are applied on you personally. Okay, it's not paid by your company, and they vary across the world. But here in the UK, they start from, let's say, 8.75% all the way up to 39.35%, depending upon how much you really take in the year. So, the dividend rate, the average dividend rate is definitely in its 30+%. That is for sure. So with business asset disposal relief, what you can do is, if you build up sufficient cash reserves, and I often say the minimum that you probably should be holding in your company at a point when you want to execute this particular procedure is 30,000 Great British pounds. Yeah, okay, the more the benefit you're going to get, or the more you'll see the benefit from the tax saving. And then you can go through a procedure called an MVL, which is called a members voluntary liquidation. And what happens here is you effectively dissolve your solvent limited company business and extract any remaining money out of it in one of the most tax efficient ways, which is called a capital distribution. So you will apply a business asset or business asset relief, disposal relief will be applied, and you end up paying only 10% tax on that, compared to the dividend tax rates, which is 30% plus on average. So there's a big saving to be had going down this route, massively. But for this particular procedure, I will absolutely stress and emphasize you take professional advice. And nonetheless, this procedure cannot be done by you personally. Okay, you have to go through a licensed insolvency practitioner here in the UK, and probably if there's anything similar out in any other countries, likewise. You can't just go to an ordinary accountant either, and they will charge a fee. But if your numbers stack up, it could be well worth it if the tax savings outweighs the costs. As promised, you'll see popping up on screen here 2 useful videos that supplement this video. The first being 3 methods to get your pension money tax efficiently, and the second being pensions versus ISAs, which is more tax efficient. Now, I sincerely, as always, hope this video adds value to you and your life, and until the next video, thank you for watching and your support.